Hey everybody, Smart Silver Stacker here. Hope you're doing well. We have got a lot to talk about in today's video. A lot going on in the world. We have got the trend of global de-dollarization progressing, more and more countries and organizations dumping the US dollar in favor of precious metals or local currencies or alternative payment systems. We've got a financial crisis that is not over yet. It is just on pause at the moment due to the Fed's bank term funding program and their renewed expansion of their balance sheet, and also the coordinated bailout of the depositors at these failing banks by the Treasury and the FDIC and the Fed combining forces there. But mark my words, we still have more to see as this financial crisis continues to play out. Just this past Tuesday, we saw a big spike up in the price of gold and silver, which are still up, by the way, following the job openings report from the BLS, which was the first sub 10 million job openings report since May of 2021. And it was the second largest decline, the 2-month decline in job openings on record, eclipsed only by the decline we witnessed during the pandemic lockdowns. And tomorrow, Friday, we have got the highly anticipated jobs report for March. And if you ask me, this report is really just another potential landmine in today's environment of uncertainty, particularly if it disappoints and markets do not like what they hear. So keep an eye out for that tomorrow because things could get interesting. And one thing I've noticed is that it seems like we are beginning to see a lot of de-dollarization talk. I mean, in the alternative media, it is all over the place. Really the only thing I see folks talking about, or the primary thing at least. And even in the mainstream media now, we are starting to see some coverage of nations like China dumping the US dollar. You know, they're paying for gas in yuan now, paying Total Energies for gas from the UAE in yuan. We've got Saudi Arabia, they're on the brink of abandoning its petrodollar alliance with the US. That's starting to get some attention because that is getting much closer. That's right around the corner now, if you ask me. And now there is a very real possibility of the US dollar losing its world reserve status. And that, of course, is very big news indeed. Now, today, I want to go over some of the background for this movement of de-dollarization that we're witnessing and this move towards a multipolar world order. You're probably going to be hearing a lot more of that term moving forward, because this movement, this de-dollarization effort, it's been in the works for some time now, like a long time, you know, decades. And ultimately, this move away from the US dollar as the world's reserve, it's been inevitable for a while now. The writing has been on the wall. It's just that now we're finally beginning to witness the endgame of failed economic policies here in the U.S. You know, central planning, the Federal Reserve running off the printing press, monetizing debt, keeping interest rates artificially low, trying to stimulate the economy and not letting the free market do what it needs to do every time we experience a crisis. Now, gold and silver are beginning to react to these developments as we might expect. We can take a look at the charts here, courtesy of SDBullion.com. Gold still holding strong above $2,000, which it just blew through that resistance at $2,000 on that Tuesday job openings report. And I think that now $2,000 may be support rather than resistance. I mean, I would like a pullback below $2,000 for gold as much as the next guy. I mean, that would be a nice gift for those of us who want to get our hands on some more precious metals, but I'm just not sure that we're going to get that. Silver also over $25 today, holding on to those big gains that it put on following Tuesday's job opening report. And if you want to get your hands on some physical metal, buy your gold and silver at SDBullion.com. Right now, new customers can get gold or silver at spot by visiting SDBullion.com/new. Now, going over the background of this de-dollarization effort, I want to start off with this document from the Congressional Research Service. Now, we've looked at this document before. I think it is worth revisiting as we try to provide some context for what is going on in the world today. This document is titled De-Dollarization Efforts in China and Russia. Nice and straightforward. And this document starts off by saying, for more than a decade, China and Russia have sought to reduce their use of the US dollar or de-dollarize their economies. in an effort to shield their economies from U.S. sanctions, reduce exposure to the effects of U.S. economic and monetary policy, and assert global economic leadership. Now, this document was published back in July of 2021, and you see that it mentions that this de-dollarization effort goes back decades, even from that point. So, it's clear that this de-dollarization is part of a broader agenda that predates the ongoing Russia-Ukraine conflict by quite a bit. And to give you an idea of how long this has actually been in the works, I want to read to you an excerpt from a letter that was signed in May of 1997 by Boris Yeltsin and then Chinese President Jiang Zemin, titled Russian-Chinese Joint Declaration on a Multipolar World and the Establishment of a New International Order, adopted in Moscow on 23rd of April 1997. And this letter was written and signed following the creation of the Shanghai Five. That is the predecessor to the Shanghai Cooperation Organization, which, if you will recall, Saudi Arabia just joined. They just became a dialogue partner, and that's the first step towards full membership in this political and security and defense organization. So it gives you an idea of what the organization's founding principles are, and I'll just go ahead and read this to you now. It says, "In a spirit of partnership, the parties shall strive to promote the multipolarization of the world and the establishment of a new international order. A growing number of countries are beginning to recognize the need for mutual respect, equality, and mutual advantage, but not for hegemony and power politics, and for dialogue and cooperation, but not for confrontation and conflict. The establishment of a peaceful, stable, just, and rational new international political and economic order is becoming a pressing need of the times and an imperative of historical development." Okay, so yeah, that all sounds very high-minded, and, that's all great. I wouldn't read too much into that aspect of things personally. I mean, I don't think that Russia or China or Saudi Arabia, for that matter, is pursuing this policy for anything resembling altruistic motives. It's all looking out for their own best interest. But the point that I want to draw your attention to here is that this agenda has been in the works for a very long time. You'll notice that this letter is also signed by none other than current Russian Foreign Minister Sergei Lavrov, who notified us earlier this year, 26 years after the signing of this document, that a BRICS currency is likely coming this August at the BRICS summit that will be held in South Africa. Now, de-dollarization, this shift to a multipolar world, clearly it's been in the works for some time. And, we're going to be hearing that phrase multipolar more and more because it is getting very close now. But they've been working on this for a while. And, this is one reason why when people tell me in the comments to these videos and elsewhere that stackers, gold and silver stackers have been telling the same story about silver and gold for years, and that makes them believe that it's not a true story, that gold and silver are not really safe havens, that it's all just scaremongering. Well, it's been true all along. I mean, the signs were there for anyone who was paying attention. Really, the U.S. kicked off the de-dollarization, if you want to look at it that way, back in 1971 when Richard Nixon took us off of the gold standard, ending gold convertibility into the dollar. I mean, it was at that point, I think, that de-dollarization really became ultimately unavoidable. It's just that, it's taken a long time to get here. But now we're here. It is arriving. And now the signals of de-dollarization and this ultimate outcome, they're getting to be impossible to ignore. And if you like silver, make sure you check out Silver Botanicals and their line of amazing products powered by Nano Silver. There's a link down below. And don't forget to use coupon code STACKER to save 10% on your order. Now, all along, China, Russia, these nations that are seeking to undermine global U.S. hegemony, they've been biding their time. That is what I think has been going on here. They've been waiting for the right time to strike. They witnessed what the U.S. was doing to its own economy. They kind of knew, I think, that given enough rope, we would hang ourselves. They knew that we would do this to ourselves, and that very likely through our own, ill-advised economic policies, we would end up doing something worse to our economy than anything they could ever do on their own by all of the borrowing and spending and all, really just becoming decadent as a society. How do we know that the time for the BRICS nations and China and Russia to ultimately challenge U.S. hegemony is growing near. Well, we did just have the second and third largest bank failures in U.S. history occur within days of each other. We've got $31.6 trillion in debt now. According to Fortune magazine, U.S. banks have $1.7 trillion in unrealized losses that they're sitting on. We've got a $1.6 trillion deficit every year. Think about that. The first $1 trillion of debt took something like 200 plus years to accumulate here in the U.S. And now, every year, we're racking up more than $1 trillion in additional debt. And we also have hundreds of trillions of dollars in unfunded liabilities. That's Social Security, Medicare, veterans benefits, federal pensions. I mean, it's an unpayable amount of money. And, there's a reason that the Social Security trustees just came out with this new projection that the Social Security fund would run out of funding by 2033. That is a year earlier than previous projections. And, that probably is looking at things through rose-colored glasses too. These government numbers, these government estimates, they almost always paint a better picture than things really are. Just look at the projections of what the U.S. debt would be from back in 2013. In 2013, they were saying in 2023, we were going to have something like $21 trillion worth of debt. And here we are, $31 trillion in debt. So, very likely Social Security probably going to run out of money before 2023. And those trustees said in that report that they would have to either find a new source of funding or slash benefits. And I can tell you they're not going to slash benefits. So where do you think that money is going to come from? Well, it starts with a P and it ends in renting press. Brrr, that's going to be the sound of all of the dollars being created to fulfill all of these entitlement programs. People get triggered when I call Social Security an entitlement program, but that is what it is. It meets the definition. And Alan Greenspan warned us about this, back in 2005 in congressional testimony. I'll play the clip for you of what he said.
Do you still believe that we should maintain the fundamental principles of Social Security as he did in 83?
I think we should maintain the principles of Social Security, but I think the existing structure is not working, and that until we can construct a system which creates the savings that are required to build the real assets so that the retirees have real goods and services, we don't have a system that's working. We have one that basically moves cash around. And we can guarantee cash benefits. It's far out and at whatever size you like, but we cannot guarantee their purchasing power.
So, obviously Alan Greenspan understood what was going on, and now we are reaching that point, I think, in the relatively near future, where we will be getting these payments that, they come through, but they just don't buy anything. And we also have the highest level of credit card debt on record right now. We've got the highest level of household debt on record. And of course, we also have the Fed raising rates into this giant debt storm that we find ourselves in. And that is putting a strain on all of this debt that's out there. Just look at the banks and their U.S. Treasury holdings, all those treasuries they bought when rates were much lower. Well, now that the interest rates are cranking up, those assets are losing value. That's what happens to bonds when interest rates rise. When the yield on the bonds rise, the existing issues with a lower coupon rate, they decline in value. And that's why banks have $1.7 trillion in losses on their books, unrealized losses. That could become a huge problem, And of course, the Fed has to raise rates here because we've got inflation at 6%. So the Fed really, they're facing an impossible choice. They've got to either let the whole system implode or they've got to hyperinflate the dollar. I know that sounds like kind of an extreme call, but the more this crisis plays out, the more and more likely it seems that we might see a hyperinflation here in the dollar. I always thought that was sort of on the outside realm of possibilities, but it is looking more and more likely the way things are progressing. And I do think that the Fed has sort of tipped its hand here that it really has already given up the fight against inflation, which, was a doomed fight to begin with anyway, because they're expanding their balance sheet again. We are already seeing the balance sheet move up. In the past 3 weeks, they've erased something like 5 months worth of quantitative tightening, the drawing down of their balance sheet. And, they won't call it QE, of course, but that's just them managing perceptions. And really, I mean, we can just call it what it is. We don't have to call it QE. We don't have to call it BTFP. It's debt monetization, because those additional assets on the Fed balance sheet, those are U.S. Treasuries. Those are debt instruments. And if the Fed buys them from banks or they buy them directly from the Treasury, I mean, what's really the difference anyway? They'll tell you, of course, that it's collateral for loans, but to me, that's just a distinction without a difference. You know, what kind of a bank would take devalued assets as collateral for loans, taking those assets at par or face value, which is far above their real market value, because that's what the Fed is doing, you know, with this BTFP program, where they're expanding their balance sheet. They're taking these treasuries, which are worth a lot less than their face value, and they're giving loans based on the face value. And of course, no bank that actually had to operate at a profit would be foolish enough to do that, because it would be out of business very shortly, unless, like the Fed, you know, they had a printing press to bail themselves out with, because that's basically what we're witnessing here. I mean, this is like Banana Republic style finance, and that's what we are witnessing, but nobody wants to call it that. Except for, you know, the stackers on YouTube, of course. There's always us calling it like it is. But, you know, even if the Fed's actions here don't hyperinflate the dollar, because, I mean, who knows? Maybe they won't. Maybe it'll just lead to high inflation and not hyperinflation. It seems almost certain that if we get a Fed pivot combined with a massive coordinated worldwide dump of dollars and dollar-denominated assets, that very well could be what kicks off a hyperinflation. And that is why this financial crisis that we are living through, that we are witnessing right now, is so different than the 2008 financial crisis or even the 2020 financial crisis. Because, you know, back in 2008, China was buying U.S. debt. You know, they were loading up on the stuff. They wanted to, you know, keep the yuan down so they could keep exporting their manufactured goods. So they buy up dollars, they buy up U.S. debt. But now they're selling off the debt. I mean, they still have north of $800 billion worth of treasuries on their books. But to me, that just means that they have a lot more debt that they can dump. I mean, if they had already dumped it all and we were, you know, sailing along like we are, maybe it would be fine. But the fact is that China still has a lot of debt that they can dump, and they probably will. And I think that they're probably just waiting for the most opportune moment to do that, to inflict maximum pain on the U.S. dollar and maximum gain for China. And of course, you know, who can blame them? They're just looking out for their best interest. That is how realpolitik in this world works. We know that de-dollarization was being planned back in 2008. It was already on some of these nations' radar, but, you know, no one was really taking it seriously. But today, de-dollarization, like I said, I mean, it's mainstream news, and it seems like it is accelerating at a very rapid pace. I mean, to me, it seems like every time I read the news, there is some new country that is dumping the U.S. dollar or abandoning the dollar for bilateral trade, moving towards local currencies. I mean, stories just abound these days. It's like nothing I've ever seen before, and it's not being done in a back room. You know, this is being done out in the open, and de-dollarization is coming. I mean, in fact, it is already here. But the thing is that so far, it has been sort of a death by 1,000 cuts for the dollar. You know, we had Russia pricing its gas in rubles. We had India paying for Russian oil in rupees. We had Israel adding the yuan to its official reserves. There's some bilateral trade agreements that come out in local currencies. We've got some alternative digital payment systems coming online. They circumvent the dollar system. All of these things individually are a very small development. They don't amount to very much, but collectively, they represent an extremely dangerous trend for the U.S. dollar and its status as the world reserve currency. And when a major development occurs, that would be, for example, Saudi Arabia selling oil to China for yuan, let's say, or for any non-dollar currency for that matter, you know, and I believe that we could see that possibly this year, particularly if Saudi Arabia is inducted into the BRICS organization in August, like we've been hearing about at the annual BRICS summit held in South Africa. I mean, if that happens, that'll be a huge blow against the dollar, and that could trigger a cascading series of events which could cause the dollar to lose its world reserve status very quickly. And I think that, you know, even if that doesn't happen, even if we manage to avoid that in 2023, the writing is on the wall, and this will be taking place in the relatively near future, but it could happen pretty soon. We've already witnessed Saudi Arabia, recently they announced they were pursuing these large investments into China's oil refining infrastructure. China already is the biggest purchaser of Saudi Arabian oil, and that arrangement is only increasing. We had China, like I said, paying yuan for natural gas from French energy giant Total Energies. I mean, they're not even a BRICS nation company. They're a French company, a member of NATO, a member of the EU. Their energy companies are now selling their gas in Chinese yuan. So, I mean, this is kind of scary stuff, but things are getting very real here. And the reality is, we're living through history, folks. And just because for just about everybody's living memory, the dollar has always been the world's reserve currency, that doesn't mean that it will always be so. In fact, the dollar, it's been the world reserve currency for almost 80 years now. That's a pretty long run to be on top. And for over 50 years, the dollar has been a purely fiat currency. And that is a very long run for a currency that is backed up by nothing at all. And when the dollar's reign ends, where are people going to find security? Well, precious metals, gold and silver. It's the same place that central banks around the world are looking right now. In 2022, central banks around the world stacked more gold than in any year on record, and they are continuing to add to those physical metal positions. And when everything really begins to fall apart here, there simply will not be enough lifeboats to get on. There will not be enough physical precious metals to meet the demand that there will be for safe haven assets like this. And that is why the price of both gold and silver will be going much higher when all of this plays out. I mean, that's my forecast. And this is not financial advice. I'm not telling you what to do. I am just sharing with you my thoughts. But there is security in precious metals. These things, gold and silver, they have been money for thousands of years. They have held value for thousands of years. There's very few assets that you can say that about. And to me, I mean, they're still extremely undervalued. Gold is knocking at least on the nominal all-time high, but I mean, silver, it's at 25 bucks. It's trading at $25. That is half of its nominal all-time high of 50 bucks. And if you adjust for inflation, the inflation-adjusted all-time high of silver is somewhere north of $190. So, silver, to me, is just ridiculously cheap here. Now, it's true that following the SVB collapse and Signature Bank and with all of the uncertainty out there, there is a lot of demand for physical already, and premiums are moving higher. But to me, premiums, quote-unquote premiums, that's just the real price of physical metal. That's all. Because remember, the spot price it's just paper. It's set by a futures contract. That's what the spot price is. It's the price of the forward month's futures contract that has the highest trading volume. It doesn't actually represent physical metal. And yeah, sure, you can take delivery of your futures contract, but how many of those actually get settled in physical metal? We know that there's not enough underlying metal to settle all of them. So to me, the paper price, the spot price, it's just a suggestion, really. It's just kind of a derivative, a paper derivative of silver. And when you look at the premiums, what you're looking at is just the actual cost of physical bullion. So, I personally, I don't get too hung up on premiums. I try to pay the lowest premiums possible. And I think that really a fair way to determine the price of silver is just find whatever the absolute lowest bullion product that you can find, the lowest premium bullion product, that's the price of physical silver. Now, we're going to get to a time, I believe, that spot price, that paper price, it just doesn't mean much anymore. And that is why I am still stacking. I am getting prepared for what I think is coming. I'm doing what I can, and that's all any of us can really do. And there's a lot more you can do than just stack metals. That's just my focus on this channel. But, stack up your food, learn your skills, get as independent of systems of support as you can. Make sure you have some way to protect yourself and some security, because, look, when this all plays out, it's really going to be SHTF, at least for a little while. And, the definitions of that vary, but things could get ugly, folks. So make sure you're getting prepared. In fact, leave me a comment down below to let me know what you're doing to get prepared. Thanks for watching, everybody. Stay safe and happy stacking, and I will catch you next time. Smart Silver Stacker, out.